the week. You're on the Bull or Bear series for 2023, looking out for potential opportunities as we head into the new year. Now, we're in the second day of December. It's really close to the end of the year, and we're always looking out for where the key opportunities are. And so today, it's all about education. It's all about learning together with our experts on site. And today, for this second show of today, if you didn't join us for the first one, it's okay. You can watch the replay. Today, we've got PineBridge Investment with us. And the topic is about thinking big in Asian small caps. Now, what does that actually mean? Because, we hear the term a lot, but, we always want to dive deeper into an in-depth analysis of the topic. And so the synopsis of today, let's try to outline it a little bit more before I introduce our guest. Usually it's overlooked, these topics, also sometimes underestimated in certain cases, but we're looking at asset classes today and how they can present potential compelling opportunities for yourself. So for the past few days, I've got a lot of questions about, asset allocation. How much should I actually allocate for particular parts of my portfolio? And I know a lot of you are also rethinking your portfolio. So I think today, this particular session is for you. So with that, I would like to introduce from Intermediary Sales of Southeast Asia, PineBridge Investments, we've got John Lam. Hi, John.
Hi, Olivia. Good evening to everyone on the moomoo platform. Very privileged to be here. I understand I'm the last one out of a series of 9. As they say, save the best for last, right? So happy to be here.
Well, it's a pleasure to have you with us, John. And I know this is like your second live series with us. And of course, we're always diving into different parts of the topic. Now, we've cut different parts of the ecosystem of portfolios, right? We've done different industries the past few days. But I think today is quite a good way to end the week because, I like the topic of asset allocation. And I want to know what you've got to share with us. But maybe before we begin, could you tell the audience a little bit about yourself and why they should be listening today?
Okay, thanks, Olivia. So as as you mentioned, my name is John and I'm from the Intermediary Sales team at PineBridge Investments. I look after the Southeast Asia region, which is broadly Singapore, Malaysia, Thailand, Philippines, Indonesia, and Brunei. And I cover intermediary clients, which is your private banks, family offices, and of course, platforms such as moomoo and Futu, respectively. Maybe I'll cover a little bit about PineBridge, who PineBridge is, because I think that's a little bit more interesting than who I am. We can cover a bit about who I am later if you want to as well. So PineBridge on slide number 5, you can see is a private global asset manager. Can we turn to slide 5? Yeah, PineBridge is a private global asset manager focused on active high conviction investing. We have been independent since 2010. And before 2010, we were the private captive asset management arm of AIG Group. Some of you know AIG went through the global financial crisis in 2009, and they sold off this captive asset management arm to Pacific Century Group of Hong Kong, also known as PCG Group, which is a conglomerate involved in telecoms, real estate investments, and of course insurance as well. And it's owned by Richard Lee, or you may know him better as the younger son of Lee Ka-shing. So PineBridge, as a DNA, we were born out of crisis, and right now we are also in the midst of another financial crisis. And I think we are in a great position to help clients navigate out of the financial crisis. We're still headquartered in the US, global headquarters in the US because of our AIG heritage, but you can see we have a very strong Asian flavor. Most of our client AUM actually comes from clients in the Asia Pacific region, more than half of it. And we are also Asian owned as well. So when you look at PineBridge, you're looking at a manager who understands crisis well, who has a global presence, global footprint, but a very strong Asian flavor. And we're going to be talking about Asia's small caps later on today as well.
Got it. Thank you, John, for setting the context. I think it's important because, you provide that perspective as well. And that's why our audience is here today, to hear your perspective and also what you represent, especially in helping people and guiding them in making better financial decisions. So with that, John, before we go into our chat and live Q&A, I'm excited to find out what your insights are. The floor is yours, John.
Thank you, Olivia. So can we jump to slide number 8? So slide number 8 here is just a placeholder of the global macro and investment outlook. I think before we talk about small caps, or more specifically Asia's small caps, I think it's important to give the audience an overview of what the investment landscape is. I think this year has been dominated by 4 I's: infection, invasion, inflation, and interest rates. The first I, infection, most of the world started the year by closing the chapter on the COVID-19 infection and went about reopening. And I think this reopening also exacerbated a little bit of the third I, which is in fact inflation. But before we come to inflation, in February this year, we see Russia invading Ukraine, and that along with supply chain issues escalated inflation to a near 40-year high in many jurisdictions. And to fight inflation, in March this year, the Federal Reserve raised interest rates for the first time in 2 years by 25 basis points in March, followed by 50 basis points in May and 75 basis points each in June, July, September, and November. And we are eagerly awaiting what the result will be next week for the Federal Reserve as well. Now, the impact on global markets was quite clear. Global equities was down anywhere between 15 to 30% year to date. Global bonds are down about 15 to 20% as well. And I think the big question on everyone's mind is whether there is an end in sight. So let's move on to page number 9. I think to answer whether there is an end in sight, we really have to look at 2 factors: inflation and unemployment. I imagine a central banker in today's market environment is not very different from a train driver on a runaway train that is heading towards a suspension bridge over a 100 meters tall valley that happens to be broken or out of order right in the middle of that valley. So a pretty precarious situation, I must say. And that train driver has effectively one tool in his toolkit to stop the train, and that is the brakes. He needs to step on the brakes hard enough to stop the train before it crashes down the valley, but he needs to ensure that he doesn't cause the train to derail by being overly enthusiastic about braking. Similarly, for central bankers today, most of them have effectively one tool, interest rates, to cool the engine of the global economy. But they also have one major constraint, which is how hard they can step on the brakes. And this constraint is unemployment. And unemployment rates is something that many central bankers watch very closely, because causing sky-high unemployment would be equivalent to derailing the train. So to summarize, if inflation is very high, you can step on the brakes very hard, but if unemployment starts rising rapidly, you probably need to cool down on your braking a little bit. Personally, I think we don't need to brake as hard as we did a couple of months ago. We've already had 375 basis points worth of rate hikes by the Federal Reserve and by many central banks around the globe. And we have started to see this have an impact on inflation rates. The chart here is the US Producer Price Index, and we see evidence of a rapidly improving inflation backdrop. This 5.4% in the PPI index represents a 38% decline of prices from its October high. And PPI tends to be a leading indicator for CPI, the Consumer Price Index, because you need to produce before you can consume. On the next slide, on slide 10, we see CPI numbers. We see that it's similarly in a downward trend, but slightly shorter in terms of it being in a downward trend. This is a 4th month in a row compared to the 5 months for the PPI, where we see inflation numbers coming down from its June peak. Now, both CPI and PPI are both backward indicators. This means that we're looking at numbers that are already history. So I think what's also important is to look at some forward indicators on why this downward inflation trend is likely to continue. On the next page, page 11, we can see another chart. I think when we look at inflation, it's important to dissect down the causes of inflation. The current cause of inflation on the supply side is largely because of supply chain disruptions and also commodity prices. Let's look at the first part, supply chain, right? This chart shows the Shanghai port waiting time. The Shanghai port is the busiest port in the world. The second busiest is Singapore, which we're very familiar with. And in 2020, the annual cargo traffic handled at the port was about 43.5 million TEUs, making it the globe's busiest container facility. So the average wait times for ships at the Shanghai port does have a significant impact on a significant part of the global supply chain. We see that this average waiting times have come down quite significantly. It used to be about 173 hours in April, 140 plus hours shortly after that. Today, it's about 47 hours, and it's more in line with the longer term average. Beyond waiting times, we look at shipping rates as well. This index, the WCI Shanghai to Rotterdam container freight benchmark rate, what a mouthful, basically represents the average shipping cost of a container measuring 40 foot from Shanghai to Rotterdam in the Netherlands. We see that this rate has declined 84% from the peak, which was October last year, where it was about $14,807. Today, or rather last week, it was less than $2,200. And at 2,192, this is more than $1,000 below the 11-year average of 3,230. So what this also means is that from a supply chain constraint perspective, we see whether it's shipping times or shipping rates that have come down significantly. Let's move on to the next slide, slide 13. So maybe you shop more on Amazon than from Taobao, and you're less concerned about shipping dynamics in China than, say, the US. Although I could also argue that the shipping rate dynamics in China has a big part on the global economy. If you look at other similar indices, like the Fed Global Supply Chain Pressure Index, which integrates a number of commonly used metrics such as air freight cost indices, Baltic Dry Index, Harpex Index, and as well as PMI surveys, focusing on China, Euro area, Japan, South Korea, Taiwan, and the UK and US, you'll see that this index have also similarly declined about 78% from the peak in December 2021. So all of this is to say that if you're looking at supply chain pressures, a lot of this has already declined or is declining or has declined significantly. And we believe that going forward, this factor will not play as much in the inflation rates that we see. The next one, of course, is commodity prices. So here on the next slide, on slide 14, you can see how global commodity prices have changed year on year. So whether you're looking at metals, food, oil and gas, you can see they've declined from the peak. Metals in October is now in negative territory on a year-on-year basis. It peaked in May 2021, but today you're seeing metal prices at about 17% less than where it was a year ago. Food prices, which went up to 40% year on year in May 2021, has also similarly decelerated. Today, it's about 5.4% more than where it was a year ago. So similarly, that has decelerated as well. Oil and gas is still relatively elevated, but you can see the trend is really in terms of deceleration. October marks the 5th straight month in a row where crude oil prices or the rate of growth of crude oil prices have declined. So in conclusion, whether you're looking at supply chain disruptions or commodity-related price pressures, there are signs that this is slowing. And assuming no increase on the demand side of the equation, we should see a more positive inflation story in the 13 December CPI print. Now let's look at the other side of the equation. Let's look at unemployment, and that's on slide 15. So unemployment numbers have been very encouraging because they are low, but from a interest rate perspective or the constraint for the Federal Reserve, that doesn't really bode very well, right? So we can see here that the US October unemployment numbers were about 3.7%. It's a slight increase over September, about 0.2% increase, but nothing really earth-shattering. This chart here that you see measures the number of US job openings divided by the total number of unemployed persons. Generally, this number is less than 1 because there are usually more people seeking jobs than there are jobs available. But this year, we saw this number increase to 1.96. It was 2.26 in April. So, which means that for every job available, for every unemployed person out there, there were actually 2 jobs available, which really talk about an employees market, right? So this backward-looking data seems to indicate that from an unemployment perspective, it is still very healthy. There are very healthy levels of unemployment. But what we have heard is that from anecdotally and also from forward-looking indicators is that we are expecting unemployment numbers to rise and rise significantly. On the next slide, slide 16, we want to show one additional data related to employment, and that is labor force participation. The 20-year average for this number is about 64.2%. Basically, this measures the amount of people actively participating in the workforce. And we can see that it has declined very severely during the COVID period. You can see that big drop towards the right-hand side. And a lot of people were out of work, either voluntarily or involuntarily. There were a lot of people out of work voluntarily because they were living on COVID stimulus payments, or they had a change in terms of their life expectations, in terms of living on 1 income versus 2 income, or maybe even living on no income. And we saw that once the COVID checks started disappearing, which was in December 2021, we see this labor force participation rate jump by 4% and has steadily climbed since. But there's another factor we are expecting to drive up labor force participation, and that is inflation. As inflation continues to rise, people are starting to realize that maybe they can't survive on their existing savings. They may need to start hunting for jobs. They may need dual income instead of single income. Additionally, we probably have heard of retrenchments in the industry. In November, right? We hear of Meta cutting 13% of its staff, Robinhood cutting 31% of its staff this year, and many other tech industries cutting between 1 to 20% of its workforce. So in conclusion, from an unemployment perspective, we see that creeping up, and we believe that the next unemployment numbers, or rather the unemployment numbers that we see tonight, could signal that the Fed maybe needs to think twice about stepping very hard on its brakes. So let's move on to the next slide, slide 17. Now that we've covered the macroeconomic dynamics, let's talk about why Asia small cap. Before we talk about why Asia small cap, let's talk about why Asia. And that's on slide number 18. So when we look at Asia and we look at the inflation story, we see that Asia's inflation is moderate compared to other regions. Some of you might question this and say, hey, John, but the inflation numbers do look quite high on an absolute basis. And I think we need to understand that Asia, or rather a large part of developing Asia or emerging Asia, is developing. And so inflation numbers have tended to be high over the long run. What we need to compare is the deviation from their central bank targets. And we see that compared to United States, compared to Europe, it's not here, but compared to South America as well, Asia's inflation rate does not deviate that significantly from its central bank targets. And if you look at slide 19, for certain economies in Asia, or rather China in particular, you can see it's almost as if the Chinese economy is on a different planet when it comes to inflation. Its inflation rate is below its central bank targets, and we see that it has been consistently below the central bank targets ever since 2020. Another large economy in Asia, India, has an inflation rate of about 6.77% in October. This is the third straight month of decline. Although it sounds high when compared to their central bank's inflation target rate, which is 4%, we can see that it is relatively moderate as well. Long story short, we see this level of inflation below China's inflation target, putting a strong case for more monetary easing. And just last week, we saw the PBOC and the CBRC announcing a 16-point rescue package targeted at the Chinese property sector. And it's because of the lower levels of inflation deviation from the central bank targets that on slide 20, you can see many of the Asian economies have not hiked rates as much as their EM peers or even the developed market peers. So one impact of this on slide 22, we can skip to slide 22, you can see is that one impact of this is, of course, with regards to Forex or foreign exchange. And we see that many Asian countries actually have hit multi-year lows against the US dollar. That might normally be a cause of concern, and it definitely was a cause of concern about 25 years ago in 1997 during the Asian financial crisis. But today, we see many of these Asian economies being in good positions from a current account balance perspective or even an import coverage ratio perspective. All of the Asian countries that you see here, apart from Malaysia, run positive current account balances, excluding oil and gas. Malaysia, of course, is an oil-producing nation, and if we look at its overall current account surplus, that's about $3.2 billion in September, and it's a strong net positive. In terms of the import coverage ratio, we see most of the Asian economies having at least 4 months of imports that can be covered by forex reserves available within the central bank. So normally when Asian economies don't hike their rates as much as, let's say, the US counterpart, that would be a cause of concern, but today we don't really see that to be the case. Let's jump back to slide 21. On slide 21, we see the PMI ratios. Generally, for the PMI, anything that's above 50 is considered expansionary. Anything below 50 is considered contractionary. And we see most of the Asian economies all the way up to August were actually pretty much expansionary from a manufacturing perspective. India, the second largest economy in Asia, saw its third straight month high of PMI in the November print that was just announced yesterday at 55.7. That is 2 points above its long run average of 53.7. So from a production perspective, we see Asian economies producing or looking to try to expand in terms of the production capability and their supply chain. There are two broad economies that buck this trend. China, of course, and Taiwan. China and Taiwan, we do know, or rather more for China, is due to their COVID policies. They've been on one lockdown after another, but recent news seems to suggest that there is some light at the end of the tunnel with respect to easing some of these COVID policies. So let's look at slide 23. Right, just because Asia has moderate inflation, a substantially more accommodative monetary policy environment doesn't mean that you should just invest in Asia. What is also important is to look at valuation levels. As you can see, as at the end of October, whether you're looking at the 12-month forward PE, the green chart, or the dark blue chart, the trailing PB, you can see the valuations are at multi-year lows, right? They are quite close to where they were in the 2009 GFC or the 2001 post-dot-com bubble. But a lot of this valuation is really not justified. If you look at the bottom light blue chart, which measures the trailing return on equity, you can see the ROE levels are nowhere near your 2009 lows or your 2001 lows. This means that the derating that we had seen in the forward PE and the PBs are not justified from a return on equity perspective. A lot of it is sentiment driven. And I think that once there is clearer signs of reopening in China and the rest of Asia, we could see some of this recovery as well. So let's jump to slide 27. Now that we've talked a little bit about why Asia is a place to be from a valuation perspective, from a accommodative monetary policy perspective, I think it's also important to look at the main topic of today, right? Why small cap? So if you look at the two indices, the MSCI All Country Asia ex Japan Small Cap Index, which is a good proxy for small cap in Asia, and the MSCI all-country Asia Japan index in blue, which is a proxy for your large cap. You can see that small cap had outperformed large cap about 57% of the time, 8 of the past 14 years. If you stretch it for 20 years, you'll see that the number increases to about 64% of the time. So over the longer run, actually, small cap tend to outperform large cap on a calendar year basis. Now, on an absolute basis or annualized basis, since 2009, small cap had outperformed large cap by about 3% on an annualized basis. So this means that on average, every single year, there is 300 basis points of outperformance from small caps versus large caps in Asia. Now, some of you might ask, what about risks, right? And let's look at risks on slide 28. So when you invest in small cap, you are taking on higher volatility risks. You can see the small cap index does have higher annualized standard deviation compared to the large cap. But one thing you can see is in terms of the timeline, right? On a 3-year basis, there's a 3.5% difference. But if you start taking a longer term view, this annualized standard deviation reduces to less than 2% over a 5-year period, less than 1% over a 10-year period, and I think over a 20-year period, it will be effectively negligible as well. So this means that small caps is a great place to be in over a longer period of time. But more importantly, not just looking at volatility numbers, is to look at the Sharpe ratio, which compares the return of an investment after taking into account risk. And we see that small caps come up on top, whether it's 3, 5, or 10 years. On slide 29, you can see one big reason why we make the case for small caps, and that is really in terms of the under-owned and under-researched nature of small cap companies. If you look all the way to the right, for companies above $10 billion in valuation, in Asia, you have about 24.4 analysts researching each large cap name. And this is even more than the US, Europe, or Japanese securities. So Asian large cap stocks are even better covered than their developed market counterparts, and alpha opportunities from stock selection is harder for Asia's large cap versus Europe, US, or even Japan. But when you go down the scale, for companies that are less than $300 million in size, you see the opposite happening. Asian companies are less covered than their European, than their US counterpart at the smaller end of the scale. And this presents ample opportunities for bottom-up security selection. Moving to slide 31, these are some themes that we look out for, or rather PineBridge looks out for companies within the Asia small cap space. There are 4 broad themes here, right? In green, technological barriers. We look for companies with an R&D mentality with an accumulated technological advantage. So for example, one of the top 10 holdings in our Asia small cap fund is a Taiwanese cables and connector supplier. They have an adjusted R&D of about 6 to 7% of sales versus the competition. And this company over the past 5 years generated returns of about 218% on a cumulative basis. And even in this challenging environment, was up over 5% over the past year. So it's not just R&D costs, right? That is a very simplistic measure of understanding accumulated technological advantage, but how well this R&D cost is spent as well. And this firm cooperates with their customers' R&D team in early stages to build long-term rapport and to ensure that the R&D that they work on is truly beneficial to their end client. Next one, dark blue, cost advantages. Of course, that's easily explained. You want to find firms that have better capex efficiency, where they can expand in a low-cost way to gain market share and have higher gross profit margins versus their peers through different cycles. The bottom left-hand corner, which is in gray, is industry consolidation. We like firms in industries that are consolidating, where there are industry roll-ups. One example I can give is in the toy industry, right? The toy industry had been ripe for industry consolidation ever since Toys R Us Inc. Liquidated in 2018. In our portfolio for a very long time, we have held this Hong Kong-based global supplier of electronic learning products. And the firm was one that we liked because they were able to consolidate within the industry. One of their last acquisition was in 2016, where they acquired a California-based competitor, and they did so through an all-cash offer, relatively rare in this industry. So the acquirer was a firm that had strong cash generation business, and they were very prudent in terms of acquisition and integrating the acquired firm. After all, an acquisition could make or break your company. So it's not just looking at for firms that acquire others, but how well they acquire and how their management thinks in terms of acquiring and building market share within their niche industries. And finally, the last one, the light blue square or rectangle, is branding. We like firms that have strong branding, strong management, who is able to capture market share gains through different cycles. Our fund owns a leading jewelry retailer who has had the #1 market share in Hong Kong with 20% market share and #1 market share in China with about 8% market share. But even at 8%, there's still another 92% more to go. This jewelry retailer had a number of brands under its belt and was able to nurture its brands to drive higher gross profit margins. And the firm's share price had grown by about 60% over the past 5 years. So these are the ideas that we like within the Asia small cap space. I think suffice to say, right, what is also important to understand is the risks in this environment, and that's on slide 32. The risks, I would say, are not very different from the risks facing a large cap or even a non-Asian stock. Rising inflation and interest rates could impact capital costs and availability for companies to go ahead with expansion. Stronger than expected monetary policy tightening could set back some of the gains that we've seen over the past week. A strengthening dollar could affect and lead to additional balance sheet stress, of course. But as with the dollar being one of the best performing currencies this year, we think that the traction for it is low, as long as there are no more surprise monitoring policy tightening. Of course, zero COVID is another issue, commodity prices and supply chain constraints. So I'm going to leave more time for questions. So I'm just going to go to the summary, and that's on slide 33. So why Asia small caps? So first of all, large number of under-owned, under-researched companies. Most indices in this investable universe focus on large market cap companies, which are most of the time priced to perfection. However, one can find attractive mispriced opportunities in moving away from such well-covered names. The under-researched, under-owned nature of small caps presents a rich hunting ground for bottom-up stock pickers. Technological change, as technology is changing business models, the ownership of the profit pool in an industry is changing hands, and new winners are emerging. The small caps of today could be the large caps of tomorrow. Thirdly, shielding from regulatory pressures and benefit. And so we have seen this played out significantly in jurisdictions like China, where although it also happens in other jurisdictions as well. For well-known reasons, regulations are put in place to tame practices such as market dominance or monopolistic tendencies, and these tend to impact large caps more than small caps. Similarly, small caps are better equipped to deal with global protectionism, as they tend to be more domestic or regionally oriented than their large cap counterparts and are less exposed to potential shocks to international trade. Diversification benefits is the next one. So leading indices for large caps are getting very concentrated. If you look at the MSCI Asia ex Japan Index, which is the large cap Asia index, the top 10 names make up 26% of the weight. It went up to as much as 30% or even 40% some months ago. Today it's about 26%. So your large cap index is very dominated by just a few names. But in the small cap index, the MSCI Asia ex Japan small cap, the top 10 names form less than 40% of the total index weight. So a small cap portfolio not only allows you diversification benefits from having a large cap portfolio, but within the small cap universe as well, there are diversification benefits as well, because the top 10 names do not dominate the index. And finally, focus on companies with high capital efficiency. So typically in a competitive world, achieving high returns on capital is rare unless the opportunity space is relatively niche. Such names usually tend not to be large in terms of market capitalization. So this brings me to the end of my presentation, and I'm happy to pass the time back to Olivia for questions and answers.
Thank you so much, John, for that. Very comprehensive, a lot of good information there, solid for compelling opportunities for our audience out there. Now, we've already got a lot of questions coming in, John, so we'll save it for the end. But just to extend a bit more from the presentation you had, what are some risks and challenges in the Asian macroeconomic environment that favors small caps?
So that's a good question. As mentioned in my summary slide, we've seen quite a bit of this, especially in China, if I were to be specific to China. The biggest 73 companies, or the top 2% of firms in China, had to sign up for common prosperity goals. They had to invest about 2 to 3% of the profits back into the economy. Additionally, we've seen large firms being hammered by regulators in a bid to stamp out monopolies. From a geopolitics perspective, we see small caps tend to be better equipped to deal with protectionism, as they are relatively more domestic or regionally oriented.
Well, the next question then, with Asia small caps, does it make more sense to be more active or more passive in this space for market conditions right now and into the new year?
So I think the answer would be definitely to be more active, right? Asia small caps are very under-researched, so there are strong alpha opportunities compared to the large cap space. Additionally, right, this serves as, I would say, a double-edged sword. If you're able to pick small cap firms in Asia well, let's say you're able to pick the top 5% in this universe versus the top 5% in the large cap universe, you'll be about 10% better off in the small cap universe in terms of returns versus the large cap universe. But a big but, if you're not able to pick well and you happen to pick the worst 5% in the small cap universe versus the worst 5% in the large cap universe, you could be as much as 50% worse off. So there is a strong advantage towards managers or selectors who have very strong bottom-up security selection capabilities, and it pays to be active in Asia small caps.
Thank you for highlighting that. So what are some key trends that you see within the Asia small cap equity space?
So we are finding pockets of attractive investment opportunities over the medium to long term. Asian companies are taking advantage of recent trends such as digitalization, direct-to-consumer, environmental imperatives, and even the geopolitical rewiring of supply chains and new demand in health and home categories. As I've mentioned, one thing to note is that Asia makes up about 80% of the MSCI EM index, but the index is highly underrepresented in the broader MSCI All Country World Index. The MSCI EM contributes nearly 42% of the revenue, but only 12% of the index. So globally, in global portfolios, they're still very much under-allocated to Asia. And we expect that over time, this to be corrected, and that should be a boost for Asian companies, and similarly for Asia small cap equities as well.
And so to contextualize it with the rising rates environment, wouldn't small caps then underperform large caps? So could you just share further insights on this? Because we already got questions related to this.
Sure. So I think that's a great question, right? In this inflationary, let's talk about inflation first. Right? In this inflationary environment, what is important for a firm is the ability to pass on costs. Within Asia, large companies tend to be middlemen, right? Your Alibaba, Tencent, they are playing a middleman role. They match buyers to sellers. They match people ordering food to people delivering food. They match people who want a ride to people who are willing to drive. So for them to pass on costs, it's actually a very difficult, actually very difficult for them, because if they want to increase profits, they will become too uncompetitive. They're thinking a big spread between the two, and they're stuck between two parties. Additionally, many large firms in Asia have grown large through debt, and they tend to have low cash positions. We see quite the opposite within the small cap universe. Of course, this is a generalization and names could be very different from one name to another. But generally, many of these small cap names, especially those that have a big market share within their niche market, they're able to pass on costs well. They tend to be cash rich. And this means that they tend to do well in an inflationary and a rising rate environment. Additionally, there are also pockets of opportunities for them to acquire without coming into the purview of anti-competitive regulators.
Thank you for that. I think that is a great way to end off our fireside chat before we take on some of the hot questions that we have from the audience. So thank you, John, for your presentation, for sharing further insights, and we'll take it further later on. So I'll be back with you shortly because I'm about to do our first giveaway. See you soon, John.
See you.
Okay, the audience watching, if you missed the last show, this show is your chance to walk away with some giveaways from our teams to you. So for the first 5 people who can get it right and fastest fingers first, will walk away with something from our teams. Are you ready? The first question in 3, 2, 1. Compared to Asia large cap names, Asia small cap companies are number 1, under-owned and under-researched. 2, over-owned and under-researched. 3, under-owned and over-researched. Or 4, over-owned and over-researched. What do you think? John highlighted this earlier on. What is your answer? We've got people just flooding the gates with every possible answer. All right, looks like we have our winners. Congratulations to the top 5 people who got this right. The answer is 1. All right, the teams will be in touch to the winners. Okay, so you've learned the insights, and as always, it's useful to apply what you just learned. And this is one way I would say you should pay attention to, and maybe a key takeaway for yourselves if you're interested in, subscribing into this fund and also applying the insights that you learned into your portfolio in a practical manner. Listen for the next few minutes before our second giveaway so that you can also help yourselves in guiding yourself into a better investment portfolio and decision-making process. All right, so everyone, open your app. Okay, so once you open your app, you can see the first page would be like this, right? So you click on trade and you click on that icon right there, follow the screen, and you should be able to be directed into this page. Okay, so you click on the fund houses. Click on fund houses, and it will direct you to the available funds that we have on the platform. These are all the information or minor details that you need to know. It's very, very straightforward, but for the purpose of today, I think you should scroll down on your app and click on PineBridge. Okay, so you see PineBridge right there, click on it, and it'll direct you to the page where all the available funds and what they actually have in store with the fund names, the different names. So if you want to research and do your own self-analysis regarding the different fund names, you can click and play around with it and see which one is most suitable for yourselves. So for this one, let's click on Asia ex Japan Small Cap Equity Fund for the purpose of this live show. Click on that, and you'll see the fund details. Now, this is important because you've got all these different instruments and tools that you need to make a decision. And I work with details. I know a lot of you also work with details. You want to know as much information as possible and also what instruments there are available for you to customize according to your own risk appetites, according to your time horizons. So if you see in the fund details, you can see the trend charts. You can, adjust the time horizon accordingly. You see, where you would like to, cut off in terms of your own analysis. And you can also see the net asset value there, the yields that you will generate in percentage. And of course, one key takeaway, you should leave from this short demo is to go into news and analysis. Now, comments is mostly about the community, what is being said about this fund, and also it's about investing together, right? It's not being alone in this process. So comments is for those thoughts. It's its own social media system within the app. Go to news and analysis if you want to have access to the fund documents, the summary, and also the fund managers available, and also the asset allocation, the percentages, and also the really, nitty-gritty that you have to know about this particular fund. Okay, so those are really important tabs that you might want to pay attention to. And if once you made your decision and you want to perhaps subscribe to this fund, you can go down the bright orange right there, click on subscribe. Click on subscribe, it'll take you to this page. Very straightforward. You input a minimum of 100 USD for this particular one. And of course, you've got to go and choose your paying account with that. So, it could be the universal account or any other available ones that you have on your app. And then you can click on subscribe and you're good to go. Very, very simple, at your fingertips, on the go, wherever you are. And if you have any other questions related to this, we'll leave an email at the end. But of course, take this chance, this opportunity to talk to our teams in the chat room. We've got our teams right now in the chat room to answer any of your questions. So drop any questions you have related to the app or to John right now in the chat box. Hope that was helpful for everyone. Okay, on to quiz 2, the second giveaway. Top 5 people, fastest fingers first, and you've got to get it right. Are you ready? In 3, 2, 1. Number 2, as of 31st October 2022, the Asia small cap benchmark has had a greater Sharpe ratio than the Asia large cap benchmark on a 1, 3-year basis only, 2, 5-year basis only, 3, 5, and 10-year basis only, or 4, 3, 5, and 10-year basis. What do you think? Is it 1, 2, 3, or 4? You guys are very quick, as always. All right, we've got our 5 winners. Congratulations. The answer was 4. So congratulations to those who actually got it right. Our teams will be in touch with you. Okay, I've picked out my favorite questions that I believe are most relevant and helpful for the audience right now, today, listening in, and still we've got questions flooding in. So I would like to invite John back onto the floor to answer our live Q&A. Hi, John.
Hi, Olivia. Nice to be back.
Hi, welcome back. So we've got a couple of questions for you. And I think, the first question, of course, is related to what you just shared. So, I think most of them are related to what they should look out for. And we've got a couple related to that. So I've kind of grouped some together. Okay. So the first question, let's jump straight into the small cap. So what would you say are the top 3 advantages of small cap in Asia over the US? So some comparative analysis here.
Okay, sure. So can we show the slides? Let's go back to slide 29. So one big advantage from slide 29 you can see is that small caps in Asia, for those that are less than 300 million, you have 2.1 analysts looking after each firm. Those below 100 million, you have about 1.2 analysts. Whereas in the US, which is the dark blue line, there are 3.4 analysts and 2.2 analysts respectively. And if you're looking at the 300 to the 1 billion size, you're also looking at similar statistics as well, where US is better covered than the names in the Asia region. So in terms of under research wise, Asia is a lot more under research than the US is. So that's one reason. I think another reason would actually be more about Asia itself than the US. Asia is actually, in terms of forward PE, trailing PB ratios, is at a low point right? Whereas we've seen a bit of gains in the S&P 500 over the past couple of months, and similarly for, let's say, the Russell 3000 as well. So from a valuation perspective, Asian companies are at a better valuation now compared to the US. Of course, there are some genuine reasons for this, but not all of them can be explained away by return on equities. I think a large part of it is sentiment driven, and also a big part of it is also regulatory driven due to concerns about China. China is a big part of Asia, but it is not all of Asia. And we have also seen a lot of the a lot of flows out of China benefiting other parts of Asia. So, for example, India, Vietnam, Indonesia have been strong beneficiaries of a China plus one strategy. So, it is still good to be in Asia because even if there are concerns about China, it can still be captured in other regions within Asia itself. So I'm trying very hard to come up with a third reason, but I'll say that one important reason for a third reason would also be in terms of the flight flight risk. So a lot of Asian companies right now at this juncture are pretty much owned by Asians. So a large proportion of it is owned by Asians. And when you own companies in your own backyard, you're less likely to have a flight response in relation to any negative news. Whereas for the US, it tends to be more broadly owned in a sense. That's where things are at the moment. And so from a additional downside, I would say you're probably looking from just this aspect alone, looking at less downside versus US small caps.
Mm-hmm. Now that you brought up China, let's open the discussion for that because there are so many questions related to this. So I picked out the top 3 questions. The first one, will China be reopening, the plans to reopen cause input prices to make a comeback? And what's the time horizon for that based on your insights? And the second one is really talking about, what kind of variables can we look at to see what affected the import-export of shipping timelines and costs?
Okay, so let's tackle the first question, which is if I were to summarize, if China were to reopen, what would be its impact on input factors, right? So there are two opposing effects happening if China were to reopen. One is there'll of course be additional demand on commodities, on inputs, right? So if people start to, if the lockdowns were lifted, if people can travel about easily, you probably see more cars on the road, you see more consumption, that will drive demand for some of these commodities. So that could have a incremental effect on cost push inflation. But on the other side of the equation, right, which will be the supply chain wise. So we did discuss about how supply chain pressures have been easing. That will be eased even more, and that would put a downward pressure on prices. Additionally, having factories be able to produce more. We saw the PMI index for China being about 42 or in August. And I think right now it's close to about 43, 44. So it's still in a contractionary mode. And China being the factory of the world provides a large part of the goods of the production required for further value-added materials or value-added goods. So that also would be I'll say diminutive in terms of inflation pressures. Whether which of the two forces is bigger, I would tend to lean more towards China's reopening being better from an inflation perspective because of the supply chain improvement of the supply chain, and also in terms of the improvement of the production that would drive prices lower.
Mm-hmm. Thank you for highlighting those 3 points. Now, next question is about the stock performance. So, the lockdown, the policies in China in the past few days, of course, all the revelations that have happened have affected the China stock performance. So any telltale signs or indicators to look out for before I enter the market or even to stay in the market as a seasoned investor? And is it DCA is the best option for China stocks at the moment?
So if we look at valuations wise, right, China is very cheap at the moment. I think if we go back to the slides and we go to slide 24, 24, yes, 24, you can see these are where the average forward PEs are for different countries within the Asia ex-Japan region. You can see China is lower than the Asia ex-Japan on average, right? 15.1 versus 15.6 for 2022, 15.2 for 15.4 in 2023. Additionally, you can see in terms of the earnings downgrades, it's about 57%. So a lot of earnings downgrades have already happened in China, and that has factored in terms of the prices. This forward PE wise for China is pretty low, right? Usually it's around the 20s. Right now we're seeing about 15. So from a valuation perspective, China is cheap. But within Asia, there are other cheaper regions. In Hong Kong is one. Hong Kong largely tied in terms of its fate to China as well, but also Taiwan as well, right? We see Taiwan being 10.2, 10.0, and China has not had as much earnings downgrades, 35% versus China, but yet having a lower average forward PE. So I think looking at this from a valuation perspective, it seems to signal that it's a good time to go into China. But at the same time, there are pockets of other opportunities like South Korea and Taiwan, which are lower PE, which might be good to go into while awaiting signs of recovering in China. I think when it comes to China, one big issue that investors face is with regards to regulations. It is hard to predict, right? I think even if you are a member of the CPC or CCP, you would also find it hard pressed to predict what are some of the regulations that would come out. But I think when we look at China, we need to remember that China's regulations are really aimed at a couple of things, right? One is they want to bring down the cost of living for the average person in China. China did a census a couple of years back. They realized that their working age population has already started declining. Their population will start declining by 2030, and that they needed to put in measures to reduce cost of living so that people will be willing to have more kids. They realized that the top three components of average households expense was housing, healthcare, education. They took care of education by removing the tuition industry. They took care of housing by reducing capital to large property firms and trying to redirect the capital elsewhere. Healthcare wasn't as easy to tackle, but it was done through other means, basically encouraging generics and so on. So I think if we try to steer clear away from industries that we think will be heavily targeted in China, I think that should be fine. But these industries tend to be large cap. The larger names tend to be hammered more, and these industries also tend to be in areas of this property, healthcare, and to some extent education as well. So long story short, I think valuation-wise, it's a good time to go into China. There are cheaper valuation elsewhere, but it's always good to diversify. Number two, regulation is always something we need to be concerned about. So we need to be careful about which industries we go into, which firms, type of firms we go into as well. And I think finally, end of the day, you can't really predict what regulations are going to be like. But if you have a large enough time horizon, I would say DCA is probably a good time to go into China because valuations are quite cheap at the moment.
Thank you for that comprehensive answer. I mean, you've already answered two of the other Q&A questions about key sectors for depressed valuation that will recover the most and the fastest. So thank you for highlighting those points. So next question, someone would like to know what is the time frame you advise if we invest in small cap, 5-year above, and when is it likely to multiply for the market cap? This is from the user as well. They like small caps because they're looking to grow their portfolio, but they find the hidden gems within small cap to be quite difficult. So things may change in the future as well. So is there any other countries they could look at other than China? And I know you mentioned Korea as well, and also Japan and all the other East Asia countries. But, you know, if we were to put it into a more macro scale, what else would you suggest?
So I think if you were to look at a more macro scale, I wouldn't limit myself to just one country. I'll probably look at Asia broadly, so an Asian index or Asia small cap manager that is renowned and famous for picking stocks in Asia. I hate to put a shameless plug in, but I think PineBridge could be worth considering. And I think beyond that, if you're looking in terms of timeline, right, let's look at slide 27 in terms of timeline. So you can see here in terms of timeline, since 2009, small cap had outperformed large cap. It's about 3% outperformance on an annualized basis. But of course, there are periods of time where small caps have underperformed as well. Between the 2016 to 2019 period, where rates were being cut, right, we see large cap outperforming small cap. But during periods like now, where there are more concerns about inflation and interest rates, or just after a crisis, we see small caps outperforming large caps, which is the ticks that you see. So I would say that while large cap should form a core component of your portfolio, it's good to have a tactical allocation to small cap. But in terms of timeline, it's the longer the better, right? On slide 28, you see standard deviation differences between small cap and large cap. Being smaller, the longer the term you go. So I think anything 3 years and below is probably a little bit too short term for you to reap the benefits, and probably something like a 5, 7, or 10 years horizon would be the kind of level you want to be if you are looking at small cap Asia.
Good points there. So last two questions. What is the probability in picking the winners within the large cap and small cap space? So for example, if I were to say large cap, 80% are likely winners, small cap 40 or 20% are likely winners, what would you say is that allocation at the moment, or at least for the next year?
That's a tough question. I don't have any numbers on hand. So anything that I give would be pretty much a rough approximation. So I think to some extent you're right? That you'll be more likely to pick winners than in the large cap versus the small caps. Because on slide 29, right, if you look at large cap, there are only 329 companies in the large cap space for Asia, for those above 10 billion, right? So you're more likely to be able to pick a winner because there are a lot less to look at. If you're looking at 300 million and below, right, you're looking at 12,000 companies. That's like 40 times more companies to look at. But I think to really drive home the point, right, what to look for, right? Slide 31 shows what we at PineBridge look out for: technological barriers, cost advantages, branding, industry consolidation. These are really the 4 key themes, right? So I think it's not too hard to filter away when you start to look at firms that have a technological advantage over another firm. On a cap basis, they might be considered small cap, but they tend to have a big market share within their industry. And if you look at branding as well, just because a firm is a small cap doesn't mean that they don't have they don't have branding, right? So one example I can give is I'm not supposed to name names, but one example I can give, if I try to anonymize it, would be this garment producer in China, right? So this garment producer produces about 1/4 of the garments for Uniqlo, for Adidas. So Uniqlo, Adidas are big names. Uniqlo is like the largest name on the Japanese index, right? But this firm itself is not a big, but it is a big part, or a big producer, big part of the supply chain, and because of that, it's able to push cost pressures away to their buyers or even to their suppliers itself. So I think long story short, opportunities exist, right? But it doesn't mean that you just take a dartboard and start throwing. You do need to do your own research in terms of what to look out for. Alternatively, you could look at finding a strong Asia small cap manager who has had a strong track record of picking stocks within the Asia small cap space.
Thank you for that. Last question. There are all these uncertainties in the Chinese macro environment, and it seems like it will take a while to head over to a more stable state. So the focus will shift to perhaps other markets. So do you still see small caps outperforming large peers with the uncertain environment? And what could be the funds or the stocks from small cap worth investing if you were to share some of your perspectives on that? So is there also perhaps an ETF for this? And what other instruments can I use to stabilize this part of my portfolio?
Okay,
Thank you for the question. Long
yeah,
question.
that's
So
a long question with many parts. Let me try to digest that and try to tackle each of them one by one. So
small
I think
cap.
yeah.
You'll see small caps outperforming the large peers within that uncertain space.
Yep. So I think whether it's as I've mentioned earlier in terms of the inflationary and interest rate environment, that actually benefits some small cap names over the large cap names. The large cap names that we have in the index, apart from some which are very cash rich, the rest are actually quite cash poor. They are high leverage. They unable to pass on costs effectively, and because of that, they're disadvantaged in an inflationary and interest rate environment. So that doesn't really change, or rather, this kind of environment does benefit small cap to some extent. The other question is what instruments, right? In terms of ETFs or mutual funds, right? So I think the PineBridge, we do have a Asia small cap ex-Japan equity fund. It's one that has performed well over the very long run. On the shorter run wise, of course, there has been challenges as with any particular market. That could be one that you could consider. ETF wise, there are some ETFs out there which you could look at. But as I've also mentioned earlier to one of the queries, whether it pays to be active or passive, I think in this current market environment and with small caps, being active actually does pay dividends over being passive. But of course, you need to find a manager who has that strong capability in active management as well.
Thank you, John, for answering all these questions. Now, just to round off that particular questions, would you say there are other funds or stocks from small cap worth investing, and anything within the ETF space that you would like to share?
So I'm not supposed to talk about any particular securities, right? If I do that, I think I'll get in trouble with my compliance team.
So maybe as an instrument.
Yeah.
Mm.
But I think there are some good small cap mutual funds out there. I think there are some on the moomoo platform as well. And I think in terms of small cap companies, if we go back to slide 31, right? Really the focus for us at PineBridge, right, is really on technological barriers, cost advantage, industry consolidation, and branding. I think if you can find these 4 key themes within the small cap names, you could be well pleased. But of course, end of the day, diversification matters as well. Don't put all your eggs in one basket, but make sure that your basket doesn't have too many holes.
Great point right there. Thank you for really answering these questions in such a comprehensive manner. I'm sure the audience appreciated it. And I know there were a lot more questions that were sounded out, but those were the few that we picked out and we believe would benefit the audience. Now, John, just to end off the show and the final show for the week, what is that key takeaway you would like to leave the audience with going into the new year?
So, I think one key takeaway would be to look for tailwinds that can power through a recessionary environment and look for companies that will benefit from them. I think there's anybody on the street will probably tell you that we're facing a recession, but during a recession, there are also opportunities as well. I know moomoo is a Chinese-backed company, so there's this saying that the Chinese word for crisis is made out of 2 components, 危机, right? One for danger and one for opportunity. So in every crisis, there's always opportunity. We just need to look out for them.
Love that. John Lam, everyone, Intermediary Sales of Southeast Asia from PineBridge Investments. Thank you so much, John, for joining us today.
Thank you very much, Olivia, and thank you to everyone on the moomoo platform.
Thank you. And we hope to see you for the upcoming shows next year.
Thank you. Look forward to that as well.
To everyone watching, thank you for being here with us, and we hope you enjoyed John's insights from PineBridge Investments. Now, we're going into the last giveaway for today to reward you for being here with us, and we hope to see you for the next shows as we end off the new year on a high. Are you ready for the next question? Remember, the 5 people get the right answer, but also the fastest fingers first will walk away with something from us. Are you ready? In 3, 2, 1. Which of the following regions had the lowest annual inflation rate deviation from central bank targets? 1, United States, 2, Euro area, 3, Asia AE, or 4, Asia EMDE? Looks like we have our winners. Congratulations to the 5 people. The right answer was 4. Our teams will be in touch, and thank you for joining us and being a part of this. Okay, so to everyone watching, I promised you the email. Here's the email if you'd like to drop us any more questions you had for John or about the app, okay? Drop us any type of email. We will get back to you as soon as we can. And of course, with more sound bites and recaps from the shows we had for the past week, you can tune in here by scanning the QR code and follow us for more information. And for the fun content, the fun educational content that we have for you on our main shows, we have all our lives right here on our social pages. Scan the QR code for more. Okay, we always have great things for you, always something new in store, crafted, curated just for you and what you want to know. So if you have any suggested topics that you want to know more of, do leave us a message on our Instagram, on our YouTube channel, and we'll always read it as much as possible and try to get back to you and also craft content related to what you want to see. So I hope to see you on those forums. Okay, and the World Cup is happening right now. This is a great campaign, and it's also a chance for you to help yourselves hedge during these times. So do check out this campaign for more information, and I hope you enjoy the World Cup happening over the weekend and tonight. Okay, thank you everyone for joining us for a series of amazing shows with our experts and their analysis. I've learned a lot. I hope you've learned a lot, and it's always great to engage in discussions together, especially with the great questions that you came up with and from our seasoned and new investors out there. So we look forward to the next show next week. More details. I'm not going to tell you what it's about. More details will be seen on our social media pages. So stay tuned on the moomoo app and our social media pages for more live info for the next show. So I'll see you then. Thank you once again. I hope you have a great Friday and a great weekend ahead. We'll see you soon. Signing off, I'm Olivia Higgins. Take care, everyone.